Supermicro jumped 10.4%. Lab scores at 47 hold. The market is chasing their speed in packaging NVIDIA's GB200 silicon into high-density liquid-cooled racks. Yet, assembling these complex systems severely squeezes their structural margins. Our Denver Stock Lab teardown reveals whether this thermal engineering moat can actually survive the upcoming global supply chain bottlenecks. Supermicro's 10.4% surge today defies an underlying engineering reality. Its proprietary direct liquid cooling (DLC) solutions, while innovative, are facing diminishing returns on thermal density gains beyond 120 kilowatts per rack. That's the maximum power dissipation rate before the cost of liquid infrastructure outweighs performance. This physical constraint means SMCI's speed-to-market mode, while potent, is inherently short-lived. The company excels at rapidly integrating NVIDIA's Blackwell NVL72 platforms, which pack 72 GPUs into a single rack, but the thermal management for these 120 kilowatts beasts requires flow rates and CDU, coolant distribution unit, the system that pumps and cools the liquid, redundancy that push current liquid cooling tech to its limits. While Dell and HPE struggle with longer design cycles, SMCI's modular building block approach allows them to quickly deploy custom chassis that house these high TDP, thermal design power, the maximum heat generated by a component that a cooling system is designed to dissipate, GPUs. However, their proprietary backplane designs, which connect components within the server, diverge from open standard OCP, Open Compute Project, an industry collaboration on open-source hardware designs, specifications. This creates vendor lock-in, but also slows broad industry adoption of SMCI's specific innovations. Today's price jump is a bet on integration speed, not a fundamental shift in thermal physics or long-term architectural dominance. Quarterly financials showing modest revenue momentum for Supermicro. The Fed's 3.63% rate isn't just a number. It's a direct hit to SMCI's CapEx budget. By Q4 2026, intensifying macro factors and sector rotation will compress Supermicro's valuation multiple by another 15%, driven by rising capital costs and shifting investor sentiment. A normalizing yield curve lifts borrowing costs for the equipment upgrades the company needs. Margins are already under fire. While CPI sits at a mild 0.6% YOY, the price of specialized liquid cooling parts, CDUs and quick disconnect couplings, remains elevated, eroding SMCI's gross margins. Beyond finance, renewed trade wars surface with Trump tariff uncertainty, flagging possible duties on critical server components imported from Asia and inflating cost of goods sold. China sales are now a bottleneck. U.S. export controls on NVIDIA's H800 and H200 chips blunt SMCI's ability to ship high-performance GPU servers to Chinese enterprises, forcing a pivot to North American hyperscalers. That shift leaves the company exposed to any disruption in the Taiwan Strait, where its key motherboard manufacturers are clustered. Geopolitical risk now caps upside. Supermicro, server integration, is trading below its 20-day average. Segment 3, the PR Insider Filter, SMCI management's headline this quarter, $39 billion in AI server orders from over 20 customers. That phrase is designed to make you feel demand is unstoppable, while steering you away from the $7 billion equity raise that just diluted shareholders by 15%. They want you to focus on the backlog, not the cost of funding it. Here's the decode. No insider buying in 90 days, zero. When executives with skin in the game stay silent, it's not confidence, it's caution. R&D spend is up 37% YOY, but as a percentage of revenue, it's flat at 2.9%. That's not scaling, it's treading water. And while management touts diversified enterprise demand, the Q&A reveals the truth. A single large customer pulled shipments, cratering revenue guidance. That's not diversification, that's concentration risk dressed as stability. Last quarter, they called expedite fees temporary. This quarter, they're hopeful tariffs will ease. Hope is not a strategy. The Q&A is where the cracks show. Analysts asked about margin drag from delayed shipments, and management pivoted to strategic decisions. Corporate speak for "we're managing optics," not operations. Watch the 10Q for one line. Inventory valuation adjustments. If that number ticks up, it means SMCI is sitting on aging components they can't sell at full price. That's the canary. Ignore the $39 billion headline. The thesis breaks when the write-downs start. The momentum breakdown for Supermicro. RSI sits at 30, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case for Supermicro rests on its unparalleled speed-to-market advantage in integrating NVIDIA's next-generation Blackwell GB200 platforms into high-density, liquid-cooled racks. This rapid deployment capability drives unprecedented demand, promising significant margin expansion as SMCI ramps up production of these fully integrated solutions. The market is betting on SMCI's ability to capture the lion's share of AI infrastructure CapEx dollars flowing into thermal management at 120 kilowatts rack densities. But here's what breaks the bull thesis. The structural margin erosion from aggressive ODM, original design manufacturer, companies that design and manufacture products that are then rebranded by other firms for sale, price wars, particularly as Foxconn and Quanta move to direct sales with hyperscalers like Meta and Amazon. This, coupled with the permanent reputational damage and potential NASDAQ delisting risk from unresolved accounting investigations, fundamentally undermines investor confidence. The pro-level question is this: how does Supermicro maintain its speed-to-market moat against ODM direct sales and Dell/HP catching up in liquid cooling, especially with ongoing accounting issues? The lab's answer: SMCI locks in buyers through proprietary management software and deeply integrated, rack-level plumbing that makes mixing vendors highly inefficient. However, this stickiness is eroded by any perceived financial instability. If SMCI files its audited financial statements by Q3 2026 and stabilizes gross margins back toward 14%, we project a path back to $50.17, its resistance level, on renewed institutional trust. If accounting delays persist and gross margins dip below 11.2%, expect a retest of $27.78 support, driven by customer churn. The lab's call: SMCI is a speculative execution play. The 47/100th AI score reflects low conviction until audited financials are filed and margin stabilization is proven. Here's the macro picture shaping Supermicro. Tightening U.S. export controls on advanced silicon directly restrict SMCI from shipping high-performance GPU servers containing NVIDIA H800 or H200 chips to Chinese enterprise customers. This regulatory barrier forces a strategic pivot toward North American hyperscalers, though the company remains highly vulnerable to supply chain disruptions in the Taiwan Strait, where its key motherboard manufacturing partners are concentrated. The massive industry-wide transition to liquid-cooled AI data centers is driving unprecedented demand for SMCI's liquid-assisted cooling distribution units and modular rack integration. This trend will accelerate as the company ramps up production of custom architectures designed specifically to house NVIDIA's next-generation Blackwell GB200 platform and high-bandwidth memory architectures. The primary near-term upside catalyst is the rapid margin expansion expected from high-volume shipments of fully integrated liquid-cooled racks to Tier 1 cloud service providers. Conversely, the most critical downside risk is the potential for severe customer churn and NASDAQ delisting stemming from unresolved accounting investigations and delayed financial filings. SMCI's 12% revenue miss on 40% lower AI server shipments is the only number that matters right now. Wall Street's calling this a pause. We're calling it a 10Q margin reset. Those 200mm wafers aren't filling fast enough, and TSMC's CoWoS yield curve just got steeper. The lab's score, 47, hold, but not for the reasons you think. Where do you see SMCI in 30 days? Up, down, or flat? Drop your call. This isn't financial advice, just the lab's engineer-level take. Markets move fast, data changes faster. Do your own research, and remember, past performance never guarantees future results. If you want our full breakdown on NVIDIA, the link is in the description. Subscribe for the only stock analysis that names die sizes and policy dollar impacts. Stay sharp, engineers.